Welcome to this explainer. Today, we're going to unpack the massive multi-trillion-dollar Islamic finance industry. We'll be looking at exactly how it aligns personal wealth with faith-based principles. Whether you're looking to understand this system for your own personal investments or you're just curious about alternative economic models, this is a seriously fascinating space. We are going to break down how an entire global financial system operates when it completely removes the concept of interest from the equation. It's a fundamental reimagining of how capital should flow through society. And honestly, the mechanisms they use to make it work are incredibly clever. Let's get into it.
Here's our roadmap for today. We'll track the flow logically, starting with the core prohibitions, comparing Islamic and conventional banking, looking at halal contracts, stock screening, sukuk bonds, and finally wrapping up with takaful insurance.
All right, Section 1, Core Prohibitions, the thou shalt nots of Islamic finance. To understand this whole paradigm shift, we really need to establish the theological boundaries that govern every single transaction. So how do you build wealth without charging a single cent of interest? Think about that for a second. To a standard Western mindset, that sounds, well, almost impossible, right? Modern conventional banking relies entirely on the idea of passive income, money just making more money while you sleep. But under this system, money is treated strictly as a medium of exchange. It's a measure of value. It doesn't have any intrinsic utility to just magically generate more of itself over time. Let's look at the specific rules that enforce this. The first big prohibition is riba. Essentially, riba means any modern bank interest on mortgages, credit cards, or student loans is strictly forbidden. Why? Well, think about how a standard credit card works. If you buy a refrigerator and it immediately breaks, you still owe the credit card company the principal, plus the interest. They make a totally risk-free profit simply because time passed, transferring all the commercial risk directly onto you, the borrower. Islamic finance requires that all financial returns be directly linked to real assets, actual trade, or physical labor. Nobody gets a free ride just for holding capital. Next up is gharar, which translates roughly to excessive uncertainty. There's this ancient prohibition in the tradition against selling birds still in the sky or fish still in the water. Basically, you can't sell what you don't possess or can't define. In the modern era, this absolutely forbids obscure, heavily layered financial derivatives where the underlying asset is a total mystery. For any contract to be valid, the asset, the price, the delivery date, and the responsibilities must be perfectly clear to protect both sides from hidden risks. And then we have Massr, which outlaws zero-sum gambling and speculation. And we're not just talking about avoiding casinos here. Think about some of the extreme cryptocurrency speculation or the meme stock options trading we see in the news all the time. Those often function as blind wagers on unpredictable price movements, rather than, stable investments in productive companies. Because one person's massive gain in those scenarios is derived directly from another person's massive loss, it completely violates the rule against generating wealth without actual productive effort. Now, beyond the structure of the deal, the subject of the deal also matters. Any capital investment must strictly avoid these explicitly prohibited industries. In a lot of ways, you can think of this as the original, centuries-old version of modern ESG investing. This qualitative screen makes absolutely sure that your capital is grounded in real, ethical economic activity that benefits society, rather than extracting wealth from harmful vices. Moving on to Section 2, Islamic versus conventional banking, a paradigm shift in risk and ownership. Let's see how these foundational rules totally reshape your everyday retail banking experience. Let's walk through this fundamentally different dynamic. When you put money in a conventional bank, legally, you are just lending them your cash for a guaranteed interest return. You're their creditor. If a business they lend your money to goes bankrupt, the bank still demands their repayment. But in an Islamic bank, you're a partner. The bank invests your funds into a compliant pool of tangible assets, and you share in the actual profits of that commercial activity. Crucially, this means if the venture takes a hit, you and the bank share in that loss together. The risk is shared. It's not just dumped entirely on the borrower. Okay, Section 3. Structuring halal financial contracts, facilitating real economic activity. So if they can't charge interest, you're probably wondering how these banks actually make money. Let's look at 3 common ways they do it. A super frequent solution for things like auto loans is called murabaha. Let's say you want to buy a $20,000 car. Instead of handing you a check for 20 grand at 5% interest, the Islamic bank actually goes out and buys that exact car themselves. Then they agree to sell it to you for, say, $22,000, payable in installments over 5 years. The profit is totally transparent upfront, and the transaction is a legitimate commercial sale, not just a money-lending exercise. The real magic here happens in step one, because the bank must actually purchase and own the car first, even if it's just for a few minutes. They are taking on legitimate commercial liability. If that car gets struck by lightning while sitting on the lot before they finalize the sale to you, that is the bank's problem. Taking on that physical risk and providing the service of deferred payments is exactly what earns them the ethical right to make a profit. Now, for home financing, they lean heavily on a contract called musharaka. Imagine this as a diminishing partnership. You and the bank go in together to buy a house. Let's say you put down 20% and they put down 80%. Every month, your payment is split in two. One part is paying rent to the bank for the 80% of the house you're living in but don't own yet. The other part is buying equity. Month by month, your ownership slice of the pie gets bigger, their slice gets smaller, and your rent goes down until you finally own the property outright. Alternatively, there's ijara. This operates a lot like a conventional lease-to-own model for heavy equipment or real estate. The big difference from murabaha is that the bank retains total ownership of the asset until the very end of the lease term. And because they are the owners, they might also hold the liability for major structural maintenance. Once the lease period is up, the ownership officially transfers to you. It adds a really powerful layer of consumer protection. Section 4. Screening the stock market. The halal investment audit. Transitioning from retail banking to global equities requires a rigorous, data-driven audit. You can't just blindly buy the S&P 500. Finding a compliant stock demands this strict two-phase process. Imagine looking at a major hotel chain. They pass the first step, the qualitative screen, because, well, hospitality is generally fine. But wait, what if that hotel has a massive casino operating right in the lobby? Or actually, what if the corporate entity is buried under billions of dollars in toxic interest-bearing debt? That is exactly where the quantitative screen kicks in to thoroughly check the financial plumbing of the business. A company passes that financial audit only if its incidental income from prohibited sources stays strictly below a 5% threshold. For instance, a software company is a perfectly valid investment, but if they park their massive cash reserves in interest-bearing accounts, that interest income must be less than 5% of their total revenue. And here's a fascinating twist. As an investor, you are actually required to calculate that tiny impure percentage of your stock dividends and donate it to charity. It's an active, ongoing process of financial purification. When we look at corporate debt, the global standards enforce that a compliant company's interest-bearing debt must never exceed 30% of its total market capitalization. Why 30%? Well, it ensures that debt represents a minority stake, meaning the company isn't fundamentally driven by high-risk leverage. If you think back to the 2008 financial crisis, which was completely fueled by massively over-leveraged institutions, this 30% ceiling acts as an incredible natural protection for investors against catastrophic debt defaults. Section 5. Sukuk, the Islamic bond. Moving on from the stock market, how exactly do corporations or governments raise billions of dollars for infrastructure without traditional debt? The difference between a conventional bond and a sukuk is practically night and day. A standard bond is just an IOU. You lend the government money, they pay you interest. A sukuk, however, is a tangible, undivided ownership stake in a real-world project. If a city issues a sukuk to build a new airport, investors actually own a fraction of that physical airport. The returns you get aren't just arbitrary interest rates. They are your proportional share of the real commercial revenues, like the landing fees or the retail rent generated inside the terminal. It's real asset ownership. Section 6. Takaful, cooperative risk sharing. For our final section today, we need to look at how these principles revolutionize commercial insurance. Standard commercial insurance actually feels a lot like a bet against the insurance company, doesn't it? If you stay healthy, they win and keep your premiums. If you get sick, you win and they lose. It contains those forbidden elements of uncertainty and gambling we talked about. Takaful solves this using tabaru, which means donation. It transforms your premium from a commercial purchase into a contribution to a community, almost like a GoFundMe-style pot. It completely changes the psychological dynamic from a zero-sum gamble into cooperative mutual aid. Let's look at them side by side. In Takaful, the managing company doesn't actually bear the risk. They just administer the pool for a transparent flat fee. And here's the real kicker. If the pool of donations exceeds the claims paid out that year, that surplus isn't kept by some mega corporation as profit. It is literally returned to the participants. Imagine getting a check back from your auto insurance provider just because you and your peers didn't get into enough car crashes that year. That's a game changer. Plus, all those massive reserves sitting in the pool are only invested in compliant equities and sukuk, completely avoiding interest-bearing bonds. So as we wrap up this explainer, I want to leave you with this thought. In a global economy increasingly defined by volatile speculation, zero-sum gambles, and absolutely staggering levels of national and corporate debt, could an ancient system demanding tangible assets and shared risk actually be the ultimate blueprint for modern financial stability? By insisting that capital stays tethered to real economic activity, Islamic finance offers a structurally distinct, deeply fascinating alternative to Wall Street business as usual. Thank you so much for joining me to explore this incredibly dynamic system. I really hope it gave you a clear, comprehensive view of how it all works.